Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.
Hello, my name is Michael Stoller. You know, it's been an interesting time. As we get close to the end of the season, I like to bring together people who've been with me over the years, who've been on the shows, who really will tell the truth on how they see the state of the economy, the state of the real estate climate, the state of lending in New York and around the country. My guests today include Jim Orphanides, chairman of Orphanides and Associates, Stephen Witkoff, CEO of the Witkoff Organization, Dr. Sam Chandon, I have to make sure, because I know his mother in Canada would be happy if I didn't call it. Dr. Sam Chandon, President and Chief Economist of Real Estate Economics. And last but not least, not Dr. Sam, our good friend Sam Giarrusso, President of M&T Bank, New York and Long Island. So, Mr. Banker,
Yes,
the slim, svelte Mr. Banker, what's really happening with lending in New York and around the country?
Well, I think there's a lot of perception that there is no lending going on, and I think that's the buzz in the newspapers. I think the way to explain it, probably in the most condensed format, is that people were used to the boom years of capital markets and the investment banks doing a lot of lending, especially in commercial real estate and the CMBS marketplace. And if you ever looked at the charts and saw the amount of lending that was being done on the CMBS side in comparison to what commercial banks could normally do within their capacity, there's a tremendous difference in those charts. And even if the commercial banks at this particular time went to capacity on what they can lend, it still would not make up the difference that we're missing because the capital markets are not lending at this point.
Sam,
so I think there's a perception, Mike, that banks aren't doing anything. But that I don't think that that's a true statement.
You know, I'm fortunate that I'm a weekly subscriber and on the advisory board of Sam's company, and he sends out a report. And I recently also now get the daily Federal Reserve bulletins. And you sent out a report 2 weeks ago or 3 weeks ago, where it said for the 14th consecutive quarter, commercial lending is down.
That banks have tightened their lending standards.
Banks. We're not talking about CMBS, Sam. We're talking about banks tightening their lending 14 consecutive quarters. And then you said there was something about demand? What else did you say?
Well, there are two things that banks are telling us right now and telling the Federal Reserve. One is that they're continuing to tighten their standards. The other is that demand for the loans themselves has weakened. There are fewer opportunities to develop new properties, so there's less demand for acquisition, development, and construction financing. There are fewer transactions as the market is at a standstill, and so there are fewer transactions to finance. What I would suggest is that when we're looking at those peak numbers for CMBS, that we think about those as not necessarily being sustainable. And so we wouldn't expect current numbers or even sustainable numbers a year from now or 2 years from now to return to those levels. But with regard to the perception that Sam mentions, what I would also suggest is that from the February and March numbers from the Treasury, we do know that new commitments are still being made. We had about $5 billion in new commercial real estate loans that were made by the banks in the month of February. We had a larger number than that in March, and while again these are small numbers as compared to where we were just a couple of years ago, banks are active in the market. They are making new commitments. They're largely with their existing relationships, but they are active.
Okay, Dr. Sam, now let's really ask someone who's in the business. Steve Witkoff has been on my show. I've done his life story. Steve Witkoff is an owner, a developer, an operator, and also a vulture. I'm not saying in a different manner, looking for opportunities with regard to being in the debt. What do you see today with financing for you and for other people? Because you talk to a lot of people on a daily basis. What do you see that's going on, Steve?
To me, it feels like 1993.
And what do you mean by 1993?
Where the banks were really not lending. It felt like it was pretty frozen out there. M&T lends. I mean, Sam and I are good friends, and M&T lends. But I think that they lend to core customers. I think that's who they're lending to today. And I think one of the reasons that they're one of the healthier banks out there. Sam underwrote pretty assiduously throughout the years, never really deviated. So I would assume that he would tell you that his default rate is pretty low. But you have so many banks today that are dealing with defaults, and they don't have workout departments. And so you've got lending officers who are focused on that. And you know what, Mike? It happened again. The lending market went back on again in the 90s, and I'll tell you when it happened. When all the bankers woke up and they were done with the workouts, and they spent maybe about 6 months realizing they had nothing to do, and they said, wow, we have no more workouts. Maybe we ought to lend again. And that's how it played back then.
I probably during a week or a month speak to 40 different bankers, partially because of relationships, articles, and other discussions. And I can unequivocally tell you that certainly the largest banks in New York City are not lending. Last week I moderated a panel in Washington, D.C., and I spoke to 4 or 5 major banks. Union Bank of California, we're out of business. SunTrust, we're out of business. Sovereign, we're out of business. So, and I won't get to the subject, but I'll let maybe Jim say it. And many of these banks got something called TARP money, who were supposed to use that money to lend. Jim, you've been in this business for 38 years. You've been involved with the real estate aspects. What do you see going on?
First of all, Michael, let me thank you for having me back. I was here first in December of '08, and thank you for inviting me back, and I'm glad to be here. What I see right now is that if you want to polarize the marketplace, let's take commercial versus residential. Clearly, the residential world is in a total disarray. It's collapsing around us for so many people. Foreclosure rates just this Sunday, Times printed out the spreadsheet for the state of New Jersey, 92,000 foreclosures. If I'll do the simple math, that means 360,000 New Jerseyans are facing foreclosure, which means eviction from their homes. I don't know that that's a healthy indicator of how the economy is going in a state like New Jersey that's very dependent and reliant on what happens here in Manhattan and New York City. That's just one example. On the commercial side, we clearly have not seen a lot of volume because there's really little or no business that we see percolating through the systems that I came from in the traditional form as being a service provider in the financial service industry. So the law firms are not really working very fast or very hard or very long. I hear senior partners barely are able to put 1,000 billable hours out in the course of a year, which means there's little or no activity going on. So,
but that trickles down. But that Jim, that's going to trickle down to the employees. If a partner in a law firm has less than 1,000 hours to bill, then they don't need as many people. I mean,
that's
Mr. Witkoff practiced law.
That's right. Steve is, and I know Sam is also a lawyer. But at the same time, their business models that we've all relied on are right now in disarray. And part of that reason, and I'm going to say, I admire the banks that are today trying very hard to try to correct whatever there is the perception of the way things were done in the past to try to navigate into the future with guidelines that they are still waiting for, in my opinion. And the government has not been very clear and direct on exactly what they expect and what will be, if you make a mistake, the penalty. We need to define clearly and reward the banks that are going to really try to dispose of and to put money back into the marketplace. But the rules have not been clearly defined right now. And we all are people who grew up in a generational time
with the exception of the kid.
Where we
I'm not nearly as young as you think.
But we all learn to play by the rules. And I would simply say, tell me what they are, and then I will apply those rules and do my best job.
So I'm going to ask you. You're on the phone. You're down in Washington. You're speaking to people. What's really happening?
I think you're absolutely right. On one hand, there's a disconnect between the policymaker and the regulator. The policymaker has injected capital into the system. They've worked to shore up the banks, and there's an expectation that banks will lend. But the ways in which the banks will lend, the incentives for lending, aren't clearly defined. On the other hand, you've got regulators who are, quite appropriately, you might argue, working with the individual banks to say, be prudent, be careful, extend credit where it's appropriate. But with fundamentals and prices deteriorating in commercial real estate, those opportunities for prudent lending are few and far between.
I think you bring up certain very big values and important comments. And I'll look at Sam and I'll look at Steve in this situation. If somebody 2 years ago was going to buy a building for $800 a foot, and appraisers have this problem, they don't know how much to value a property. What's the value today? How can you determine the value of a property? I remember our good friend, Ophir Denny, always saying, the bricks are worth things. Today, the bricks aren't worth this. I mean, when you can see an AIG building, nobody's looking at it for $100 a foot. Steve Witkoff, you went downtown in 1995. You were able to buy buildings for what, $50, $75 a foot?
20 in some circumstances.
So, but then you had benefits. You had 421Gs. You had other benefits down there. Today, we can't see anybody. Nobody's even making bids on that. Nobody's making bids on a lot of property.
Well, that's right. By the way, if the banks would have lent in the last 18 months, they would have been roundly ridiculed because they would have lent they would have lent in an environment where asset values are coming way down. So the fact of the matter is they shouldn't have lent. And if you ask Sam, because me and Sam have talked about this many times, if you ask Sam why a lot of that TARP money didn't get out there, he'll tell you because the cost of funds to the banks that took TARP money was higher than the other capital that they could have lent. So all their other capital went out first, and the TARP money was going to go out second.
I mean, in today's market, for my viewers and everything, there are 4 asset classes. The preferred asset class is multifamily. And M&T Bank has been in that business. They've been a major leader in that, and you continue to lend on that. Office has been the second, but not too many people really want to lend or discuss office today. The third was industrial, which you don't have too much in the market. And the last was an industry called hospitality, which is another dreaded industry because it's really difficult. So how do you, as a banker, make a determination today on how you're going to lend?
Let me go back to what Steve mentioned when he said that he was at the last downturn, or coming out of the last downturn, he was buying office buildings in downtown Manhattan for $30, $40 a square foot, or even lower, as he said. We were one of the first banks to actually partner with Steve on that and lend him money on office buildings. Categorically, yes, multifamily is the most preferential real estate type in commercial real estate that everybody's after. It's also very competitive. Since the demand is high for it. We'll look at all asset classes, and we have always looked at all asset classes of real estate. What's important to us is that they are stabilized, that they can cover the debt, and what's materially important to us as a bank is who is behind that building. So if you're looking for ways to analyze those are the important aspects.
So I don't want to age myself, but if I go back to when I did a lot of bank consulting in the 70s, one of the biggest things was the character of the individual, the quality, the character, and the credentials of that individual. So that's where it is. Jim, what do you see going on? You live in the state of New Jersey, and I was saying before the show, I did a show on New Jersey a couple of weeks ago, and the topic originally was going to be the office market in New Jersey. The three people who showed up on the show who were major office owners said, we don't want to talk about it because it's one word. It's terrible. What's happening? Why is New Jersey, why is New York having these problems? Okay, in today's Post, as Steve Witkoff said before, Tom Golisano, who's ran for governor 3 times, and I met Tom Golisano. I was involved with his original company, a Paycheck, in the early 80s, said, I'm leaving New York. I can't pay these taxes. People are leaving New York, leaving New Jersey. What do you see going on? How are we going to stimulate this? What's going on?
What will it take to stimulate our regional economy, Michael? That's I guess, a subject for better minds than mine. But I can tell you that the job market is the most critical aspect of what I consider to be the concern of all the American families in this region. There isn't anybody that we don't know that has had some member of some family that has been impacted by the downsizing, by the layoffs, by just simply the market no longer requiring the services that they once performed. Wall Street is being right now redefined as we knew it, which employed a tremendous number of financial service, white-collar jobs in this marketplace, which is a regional marketplace, as many of them commuted as I do. I spend my time living in New Jersey, but I've worked my whole life here in Manhattan in New York City. So this is the place that I made all my money, and this is the reason why I will always be an avid supporter of New York and New York City in particular. I love this state, I love this city, and to the state of New Jersey, I make it clear every chance I get that everything that happens in the state of New Jersey starts with the dependency on what happens here in New York City. And that to that extent, it's important for us to work hard to try to shore up this very weak economic platform that is so dependent on the financial service market, to try to find different ways to create different opportunities, part of it on bringing some industrial activities back, taking, like Steve Witkoff, being a landlord and an owner and operator of buildings and properties in New York. He'll be employing people to do work and services, core services, fixing up a floor for one of his tenants. These are the important things. They will not solve the whole problem, but it will stimulate enough economics for some people to retain their jobs, to create new opportunities, and to create a groundswell. We need to get back to just after 9/11, when Rudolph Giuliani stood up and said, the best thing every New Yorker can do is go out and go to a restaurant and be seen, and start to support your local market and get back to resuming your life as normal. Right now, though, too many people are hurting economically, so they're holding back. They're holding on to their dollars, and they don't know who's really there for them as their advocate. If they had the friendly banker or the relationship banker, don't you think they'd be calling them now and asking, what can I do to save my home? What can I do to possibly help me go through this economic turmoil as we navigate, and all of us navigate through it?
But, when you talk about, I'm sorry, on the foreclosure, some of them, there was a great special on CNBC with regard to what happened. Certain people who didn't deserve houses over-leveraged the houses and the values of the situation. So I have a mixed emotion on foreclosures for certain people.
Just remember the American dream, Michael. Owning your own home is the American dream.
Right, but
tell that to all of our immigrant grandparents.
Owning your home
parents.
is, but not to leverage it 150%. I'm very sorry on that. When I watch a show and where somebody said, I knew I shouldn't qualify for this house, but the mortgage broker told me I can get this amount, and then I put the swimming pool in, and I was over there, and I knew I didn't qualify, or I lied on the statement. I don't feel for those people. For the people who are being unemployed, it's a different category. For people who
have real equity in their homes,
real equity, it's a different case, because home values are down by 20%, right, Sam?
At least. I think the core point with regard to financial services in New York is, a terribly important one. There's more uncertainty in this market than there is in many other parts of the country, because the core of what is driving employment, the core of the multiplier effect in New York City, what's driving, demand for tables at restaurants to the legal services profession, all of that rests with financial services. And until we have a better sense of, what will this industry look like in 3 years? How heavily will it be regulated? What profits will we be allowed? We don't know what the city's economy will be.
Steve Witkoff, you practice law. You started in the real estate business by buying multifamily. You told me you never saw east of 96th Street. South, everything was... past 96th Street. What do you see today? You're an investor, you're an active player, you own the Woolworth building, you have interest in many buildings over there. You were very lucky, to be very honest, in January when you sold the site to Memorial Sloan Kettering because they wanted it, but they're not working on it now because they're not doing anything on the property. They bought the site. What do you see happening as an investor, an owner, and somebody who's also looking to buy debt?
What we're looking to do is to buy distressed debt. We're a distressed debt buyer, but we also participate. In terms of buying New York City, we're a distressed debt buyer throughout the country. In terms of buying New York City, we're looking for signs. Jim just mentioned something interesting about what Giuliani said, go to a restaurant. When we started buying downtown Manhattan was when the Giuliani administration promulgated the downtown revitalization plan, because my theory is you ought to invest behind good government. And we were talking about this before. Arthur Laffer wrote an incredible editorial yesterday about what happens in states that are high-tax states. And then, of course, you saw the Golisano thing today. That's a little bit scary. On the other hand, I think Mayor Bloomberg is maybe arguably the best mayor out there today. But we're waiting to see proactively what kind of government policies are going to be promulgated out there. Right now, I don't know how you invest in New York because you have no idea what the values are. So it's hard to tell. On the other hand, I think New York is doing better than London. So as financial centers go, Sam, I think that New York comes out ahead of most major cities out there. And we own in London. So we're able to really make that comparison, and really understand it.
But what are you doing today? Would you buy a building? I hear you say that you'd buy distressed debt. Would you buy a building? Would you buy an apartment house? Would you buy retail?
We would, but the market is a disconnected market out there. Mike, in 1994, when we were buying distressed debt, I remember like it was yesterday. We bought the debt, Larry and I bought the debt on 14th Street from Home Savings Bank. It was a $18 million mortgage. We paid $900,000 for that mortgage. There's an 80-unit multifamily building with retail wrapping 14th and 2nd Avenue. 3 months later, we could have sold it for $5 million. It was a bank that needed to sell at the time. And you're going to see that. You're going to see a 6-month window.
But you brought up something, and I look, we're in the debt business. We're looking. Banks haven't really taken that. They're not at that. They're still in denial.
I think that Steve and others who are moving cautiously and slowly and waiting for the real strains on prices in the market to rear their heads are right. If you look at the escrow balances, if you look at the nature of the deterioration, the debt service covers, the impact of leases being renewed at lower levels, our expectation is certainly that the level of defaults and foreclosures that will show up on the balance sheets of the banks are bound to increase. By the end of this year, they'll probably be somewhere on the order of about twice what they are right now, and they'll be even higher than that by the end of 2010. It's those situations where assets have to be sold under duress or distress, where they're on the balance sheet of the bank, where you start to observe a closing of that spread between the buyer and the seller, and prices start to look a lot more like what you might think of as being appropriate as a distressed debt investor.
But they haven't come in yet.
They haven't
at that
yet.
level
No,
yet.
there's still a ways to go.
I mean, would I buy mortgage positions on multifamily at a 10% in effect, backing at the price I was buying at a 10% cap rate on stressed down rent numbers that I believe the apartments would rent at? I'd buy it in a minute. But that doesn't trade out there today.
But what's happening, Jim? You've seen cycles. How bad would you say in your 38 years of business experience is this cycle compared to all the other cycles that you've seen?
Well, this is a cycle that's bad because there's still too much uncertainty. Again, I said it earlier, the rules have not been clearly defined. And right now you're looking at regulations that are being put out that are almost going to reward the wrong people to enter the market to consume this.
What do you mean by that?
Well, some of the people that were the big pushers of all this collateralized and securitized debt are probably the most qualified who will have and meet that threshold density of asset. There's a certain asset rule that will apply to enter the game. In other words, pay to play. And if you have a certain amount of girth in terms of financial girth, you'll be allowed to buy this distressed asset.
I mean, and
that's the wrong group to reward.
And I agree because
reward the
under the program, you can come in with what 15%. Your leverage
less,
is
15%, but the Treasury is your co-investor, and they put in half of that.
So you come in with 7.5%, and these are the people from CS First Boston, the people from other places.
Wait, we got to define the programs, though.
That's exactly right.
I
agree with that. Define the program.
In the PPIP program,
okay,
what
please.
what Jim is talking about, and Sam probably could give everybody, you could have a whole show and an education from him on this. What Jim is talking about are the asset managers, and for that, the threshold test is, I want to say, $10 billion in assets. Probably as it should be, because they're a manager. They're not necessarily a straight-up equity investor, but there is a legacy loan program within the PPIP program, which, by the way, I am registered to participate in. I'm an individual little boutique guy. And I'm registered to participate in the TALF program
guy,
too. So,
you lent the money.
But the point is, listen, I have to tell you something. I mean, I was asked this question the other day. I think what the federal government is doing is wonderful. They're lubricating the system.
They're trying.
I think they're doing a pretty good job. I got to tell you honestly.
With these 4 people, I need 3 hours.
Yeah.
But unfortunately, I only have a half an hour. And I know that when we come back in September for the new season, that I will have all of my friends on next season. I'd like to thank Jim Orfanides, Steve Witkoff, Dr. Sam Chandon, and really the other Dr. Sam Giarrusso. See you next week.
Thank you, Michael.
Thank you, Mike.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman and Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orfanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, The Moynihan Group.